Hello, and welcome back to FOREX School from Pip Insight. This is Candlestick Price Action, the complete course. Candlesticks are the market's handwriting. Every candle is a written record of a battle between buyers and sellers, and once you can read that record, a bear chart starts talking to you. Here is the roadmap. We begin with candle anatomy, bodies and wicks. Then the four signals professionals actually use: the hammer, the engulfing candle, the doji, and the inside bar, each proven on an animated chart. After that, a chapter most courses skip, using wicks to place a logical protective stop. And we close with the lesson that matters more than any pattern, context, and the honest truth about when candles fail. Let's begin. First, the anatomy, because everything else is built on it. Every candle tells you four facts: where price opened, where it closed, the highest point buyers managed, and the lowest point sellers managed. The body, the thick part, is the distance between open and close, and it measures conviction. It shows who actually won the session. The wicks, the thin lines above and below, measure rejection, territory that was visited and then abandoned before the close. A long body with small wicks says one side dominated from start to finish. A small body with long wicks says there was a fight, and nobody won it. Hold on to that single idea: bodies show conviction, wicks show rejection, because it is 80% of candle reading. Now for the first of the big four signals, and it is the most famous reversal candle in all of technical analysis. A small body, a long lower shadow, and a story attached, a story about sellers who spent everything they had and walked away with nothing. Let's meet the hammer, and understand exactly why it works when it works. The hammer appears after a decline, and that location is part of the definition. The same shape in the middle of a range is just noise. Look for a small body near the top of the candle's range, and a lower wick at least twice the height of that body. Now read the story inside it. During the session, sellers drove price sharply lower, and then buyers didn't merely stop the move, they reversed nearly all of it before the close. That long lower wick is a failed breakdown, printed in real time. On its own, it's interesting. At a level the market has already respected, prior support, a well-tested zone, it becomes one of the highest quality signals in price action. Watch it happen on the chart. Price is stepping down, sellers in control, each close weaker than the last, falling straight into a marked support zone. Now look at the fifth candle. The market plunges all the way down to 125.44. And then closes right back up at 125.98, leaving that enormous lower wick behind. That wick is the fingerprint of a failed breakdown. Sellers spent everything and got nothing for it. The very next candle confirms the story, closing higher at 126.36, and from there the recovery builds candle by candle. Notice the order of events. The hammer told us the selling was exhausted, and the confirmation candle provided the evidence before anyone acted. The engulfing candle is conviction made visible. A bearish engulfing appears at the top of a rise, a down candle whose real body completely swallows the previous up candle's body, opening at or above the prior close, and finishing below the prior open. Think about what that actually means. The sellers didn't just show up, they erased an entire session of buying and closed the market below where the buyers started. The psychology is a trapped crowd. Everyone who bought during that previous candle is underwater within hours, and their exits become fuel for the move down. The bullish engulfing is the mirror image at a low, swallowing a down candle after a decline. Here's a market grinding higher into a resistance zone, 5 sessions of steady buying, each close higher than the last. But notice the bodies shrinking as price rises, the buying is tiring. Then the 6th candle. It opens at 130.96, a touch above the prior close, and collapses, finishing all the way down at 130.64. Its body engulfs everything the buyers did the session before. Every late buyer is now trapped above the market. Watch what follows: 3 heavy sessions straight down, with no meaningful bounce. The engulfing candle didn't cause the fall, it revealed that the buying was already exhausted, and that the sellers had taken the wheel at a level that mattered. A doji is a candle where the open and the close land almost exactly together, a tiny body with wicks either side. The session was a stalemate, buyers and sellers fought all day and finished level. Here's where beginners go wrong: a doji is not a reversal signal. It is a pause signal. After a strong trend, a doji simply says the dominant side took a breath, and what happens next decides everything. A doji followed by a continuation candle means the trend was refueling. A doji followed by a genuine reversal candle, at a level that matters, is the beginning of a story. The doji asks a question. The next candle answers it. See it in action. An uptrend is running nicely, then two small-bodied candles appear in a row, their opens and closes within a pip or two of each other. Pure indecision. The inexperienced trader shorts this immediately, convinced it's the top. But watch what actually happens: the very next candle resolves the stalemate upward, closing firmly at 115.82, and the trend continues as if nothing happened, pushing on to fresh highs. Those dojis were simply the market breathing in, the dominant side pausing, not surrendering. So here is the rule worth writing down: never trade the doji itself. Wait and trade the candle that resolves it. An inside bar is a candle whose entire range, high to low, sits within the previous candle's range, which traders call the mother bar. The market is coiling, volatility contracting, both sides waiting for new information before committing. Inside bars that form during a healthy trend lean towards continuation. The break of the mother bar's range often releases the stored energy in the trend's direction. The discipline is everything here. Traders using this pattern wait for a decisive close beyond the mother bar rather than guessing which way the coil unwinds. And a failed break is information too. It tells you who is really in control on the other side. A strong up candle sets the range, that's the mother bar, with its high at 108.94. Now watch the coil form. The next session actually wicks a fraction above that high, touching 109.02, but it can't hold the ground and closes back inside the range. The third candle trades entirely within the mother bar, a textbook inside bar, quieter still. Contraction. Then the release. The fourth candle closes at 109.24, decisively beyond the mother bar's high, and two more sessions of continuation follow. Notice that nobody had to predict anything. The structure told us exactly where the energy would show its hand, and the close beyond the range was the evidence. A candle signal without a plan for being wrong is just a guess with better vocabulary. So before we talk about context, let's answer the question that separates hobbyists from disciplined traders. When a setup like the hammer appears, where exactly does the protective stop belong? Happily, the wick itself gives us the answer, and it's beautifully logical. Here's the logic. A protective stop belongs at the price that proves the idea wrong, not at a random distance that merely feels comfortable. Take the hammer. The entire story is that sellers pushed to the low of that wick and were rejected. If price later trades back through that low, the rejection story has failed, completely and objectively. So traders using this framework place the stop a few pips beyond the wick's extreme. Beyond, not at, to allow for spread and for the market's habit of probing obvious levels. The same principle covers every pattern in this course: engulfing candles, inside bars, rejection wicks. Position size then flows from the stop distance, never the other way round. Back to our hammer, this time wearing a risk manager's hat. The rejection low is 125.44, that wick is the exact price where the buyer's story was written. So the invalidation point sits just beneath it, a stop zone around 125.38, a few pips below the extreme, protected from spread and minor probes. Entry comes on evidence, the confirmation candle that closes at 126.36. Now the trade has a complete shape, the reason, an entry, and a precise price at which the reason is dead. If the market ever trades down through that stop zone, the failed breakdown wasn't a failure after all, and the disciplined response is simply to be gone. Now for the chapter this whole course has been building towards, the one that separates genuine candle readers from pattern collectors. Because here is the uncomfortable truth: every signal we've covered today fails, and fails often, when it's read in isolation. Context is everything. Let's be honest about what candles can and cannot do. A hammer in the middle of nowhere is noise. The very same hammer at a level the market has respected 3 times is a signal. So before reading any candle, ask 3 questions. First, location: are we at support, at resistance, or in no man's land? Second, trend: is this candle moving with the prevailing structure, or fighting against it? Third, condition: has the market just made a stretched move that needs unwinding, or is the move still fresh? The same candle in a different location carries a completely different meaning. Candles are the last letter of a sentence the market has been writing for days. Read the sentence first, then the letter. And now the honest part, because Forex School doesn't do guru promises. Candle patterns are probabilities, not prophesies. A well-placed hammer shifts the odds, but it never removes the risk, and plenty of textbook hammers break anyway, especially against a strong trend. On very low timeframes, candles are mostly noise. One modest order can print a dramatic wick that means nothing at all. Around major news, central bank decisions, inflation releases, candle logic breaks down entirely because those shapes reflect panic and thin liquidity rather than orderly conviction. And hindsight is a liar. Patterns look obvious on old charts because you already know the ending. The professional response is boring and effective: demand context, wait for confirmation, size for being wrong, and test everything on a demo account first. Let's pull the whole course together in one worked example. There's resistance overhead. The market has stalled at this zone before. Price rallies into it, and now read the candles. Session after session, long upper wicks into the 124.80 area, 3 separate rejections, each high probing the zone, and each close sliding back weaker than the last. Buyers keep pushing into that ceiling, and someone with size keeps selling to them every single time. Then the break lower, 3 heavy candles down through the old support. No single candle called this move. The cluster of wicks, at a known level, against tiring closes, that combination told the story loud and clear. Let's lock it all in. Bodies show conviction, wicks show rejection. That's the grammar of every chart. The hammer is a failed breakdown, most powerful at established support. The engulfing candle is a full session erased, conviction made visible, with a crowd trapped on the wrong side. The doji is a question that only the next candle can answer. The inside bar stores energy, and the close beyond the mother bar releases it. Stops belong beyond the wick that proves the idea wrong, never at a distance that merely feels comfortable. And above everything, context first, candle second, location, trend, condition, in that order. This week, find 10 hammers on your own charts and note where each one appeared. The location will explain the outcome almost every time. And that's Candlestick Price Action, course complete. You can now read the anatomy of any candle, recognize the 4 signals that matter, place a stop where the logic actually lives, and most importantly, judge every pattern by its context before trusting it. That skill compounds with everything else in this school. If this course sharpened your chart reading, subscribe and turn on notifications, because the next Forex School course builds directly on what you've learned today. And the reminder: we never skip. Everything in this series is education, not financial advice. No method is a promise of profit, and trading carries real risk of loss, so practice all of this on a demo account before any real money is involved. Thanks for studying with me, and I'll see you in the next course.